doing business in Africa. You can't afford to be without Africa Investor.
My name is Hubert Danso. I am the chairman of Africa Investor, the African Union Continental Business Network, the African Sovereign Wealth and Pension Funds Forum, and the CFA's Global Asset Owners Advisory Council, and the board for the African Green Infrastructure Investment Bank, and I will facilitate today's dialogue. I would firstly like to thank each of you present for taking the time out of your busy COP26 schedules to be here with us. We are convening at a critical time, literally hours before the conclusion of the COP26 negotiations, where we urgently need to restore confidence and solve the vintage just transition, adaptation and mitigation finance pledge, which are asking Africa, which represents, as many of you know, only 3 to 4% of cumulative global CO2 emissions, to forego the development of our 15.2 trillion of proven fossil fuels and reserves as an endowment in return for a share of a pledged 100 billion per annum high vintage adaptation and mitigation promise. Trust needs to urgently be restored, and the investment community needs to be on guard, as it seems that there is real political momentum at COP26 that sees that responsibility for the adaptation financing passing to the private sector. This will mean that there will be an ever greater need for the private capital community to create de-risking frameworks and pathways for institutional capital to flow to fund Africa's net zero transition, which will need to be urgently tabled by the institutional investment community to encourage governments to take out the political duration and currency risks to enable the $100 trillion plus pools of private capital to flow in support of the green transition, especially in emerging markets and developing countries. To this end, the African Green Infrastructure Investment Bank Partnerships Dialogue on Enabling Institutional Investor-Public Partnerships has again convened the world's leading institutional investment community CEOs and leaders from across the continent and around the globe during COP26 because of our collective recognition about the urgent need to forge and implement innovative institutional investor-public partnerships to de-risk and mobilize the just transition, adaptation and mitigation funding that within a hospitable, predictable and enforceable legal and regulatory environment, asset owners, we believe, can leverage up to crowd in large pools of capital and co-investment to decarbonize portfolios and the green and essentially green the real economy. And thus, as a consequence of that, address Scope 3 emissions, which are, as we know, 70% of our collective challenge to meet the goals of the Paris Agreement, the Sustainable Development Goals, Agenda 2063, and the African Continental Free Trade Area. Recognizing that Scope 3 emissions represent 70% of the required carbon reductions and predominantly come from industry and the private sector, the African Green Infrastructure Investment Bank and our domestic and global investment partners believe with the appropriate policy and regulatory framework in place, given the continent's under-industrialization, the continent is uniquely positioned to leapfrog the transition faster than potentially OECD markets, and therefore believe that investing in greening the $3.2 trillion African Continental Free Trade Area that was launched this year in January, which is the world's largest free trade area since the establishment of the WTO, is a measurable and impactful platform for institutional investors to positively deliver Scope 3 reductions in Africa on commercial and inclusive terms. Again, if facilitated through an institutional investor-public partnership framework, as espoused by the African Union's 5% institutional infrastructure investment agenda and championed by a global, or championed as a global public good by the CFA Asset Owners Council in New York. Today's dialogue, in keeping with the African Green Infrastructure Investment Bank AfGIIB Road to COP27 theme and series, will be on the role of these partnerships to support Africa's green transition, the African Continental Free Trade Area, and COP27, that, as we know, will be hosted in Africa, probably around this time, November next year, under the Egyptian COP presidency, and this event will take place in Sharm el-Sheikh. Our stated goal and aim remains for this forum to design and deliver greater public-private finance mandate alignment and more catalytic private investment pathways that fast-track and scale private capital's participation in the green transition implemented through institutional investor-public partnerships such as the African Green Infrastructure Investment Bank. Today's dialogue will commence with a keynote opening ceremony, followed by a briefings segment with two high-level briefing announcements, one on the International Energy Agency's Africa Research Briefing Report, and then the other on our model law on institutional investor public partnerships initiative, where the model law's draft preamble will be launched. This will be followed by a consultative investor panel on the road to COP27. It will be a dialogue on institutional investor public partnerships, the African Continental Free Trade Area, and Scope 3 institutional investor strategies. To accomplish these goals, I'm delighted again to partner with the world's foremost institutional investment leaders and advisors committed to finding alignment and arresting the huge economic and climate damage to our economies caused by the COVID-19 pandemic and charting a prosperous and resilient pathway for investment partnerships with the continent that support the African Union's 5% agenda, where African pension and sovereign wealth funds have committed to increase allocations to regional and domestic infrastructure investment opportunities through the IIPP framework. Our elite and distinguished speakers for our keynote opening ceremony include Dr. Ibrahim Mayaki, the CEO of the African Union Development Agency, His Excellency Wamkele Mene, the Secretary General of the African Continental Free Trade Area Secretariat, Ambassador Mary Wallach, who is the Deputy Executive Director of the International Energy Agency, Marilam Frendo, who is the CEO of the Global Infrastructure Hub, and John Denton, who is the Secretary General of the International Chamber of Commerce. And to get us going, it's my distinct pleasure to call on His Excellency Dr. Ibrahim Mayaki to give us his opening keynote remarks. The floor is yours, Dr. Mayaki.
Thank you very much, Hubert. Thank you very much. Let me start by recognizing His Excellency Wamkele Mene, my dear brother, Secretary General of the AfGIIB Secretariat, yourself, Hubert, and Ambassador Mary Wallach, Deputy Executive Director of the International Energy Agency, Mr. John Denton, Secretary General of the International Chamber of Commerce, and Marilam Frendo, CEO of Global Infrastructure Hub, well, all the friends who are here gathered. I'm honored to grace this very important meeting of the African Green Infrastructure Investment Bank Partnerships Dialogue Series, focused on enabling institutional investor-public partnerships and scope free allocations in support of the African Continental Free Trade Area, which is the main strategic framework that the African Union needs to implement in the next 10 years. In 2016, the Continental Business Network was established by African Union heads of states and government as a response to facilitate private sector engagement and leadership as an essential mechanism in order to implement continent-wide infrastructure projects, particularly the regional infrastructure projects under the Program for Infrastructure Development in Africa, PIDA, as you know. The CBN, currently chaired by my good friend Hubert, aims to crowd in financing and support for infrastructure projects by creating a platform for collaboration between the public and the private sectors. And I refer very frequently to the fact that many public sector officials in our continent do not have a private sector culture. So there is a cultural issue which is dealt with and tackled through this platform. CBN fundamentally focuses on the critical role that the private and public sectors need to play in de-risking infrastructure development projects in Africa. Therefore, there is great need to mobilize both African and the global institutional infrastructure investment community, including, evidently, African and global. Specifically, the pension and sovereign wealth funds of the G7 to mitigate the infrastructure financing gap that is currently hindering Africa's infrastructure development. Greening African supply chains and trade in support of the AfCFTA is a Pan-African real economy transition plan. It is a once-in-a-lifetime and generational opportunity for institutional investors and governments in our continent to design and share the climate and economic dividends of a greener African trade ecosystem. And this is why the Pan-African Green Infrastructure Investment Bank initiative is already playing an important global leadership role in creating new and bankable opportunities in the African green finance market, which is currently highly fragmented and needs proper coordination so that an African green finance market will become a world-class international Pan-African investment platform to de-risk and mobilize the much needed global financing markets and institutional capital at a significant scale for what we call Africa's just transition. Therefore, the work of the AfGIIB initiative in providing technical assistance opportunities for development partners to participate in the setup funding arrangements where their mandates support long-term domestic and international institutional capital for green infrastructure will certainly assist Africa's post-COVID-19 economic recovery. The African Green Infrastructure Investment Bank initiative clearly complements the CBN's 5% agenda. As the 5% agenda continues to gain traction, most African governments will include in their targets to ensure that they increase the allocation of African asset owners to African infrastructure from its currently low base of their assets under management to an impactful 5% of AUM. The 5% agenda is recognized by the African Presidential Infrastructure Champion Initiative, PICI, and its aim is to have the following impact. One, unlocking notable and measurable pools of needed capital to implement regional and domestic infrastructure projects. Two, broadening and deepening the currently very shallow African capital markets, whilst at the same time contributing significantly to regional integration and job creation. And both are linked. Three, promoting the development of innovative capital market products that are specific to the continent's challenges and potential in regards to infrastructure development. Four, raising the investment interest of other institutional and non-institutional financiers, but so far have been hesitant to include African infrastructure projects as an asset to their investment portfolio based on specific, concrete next steps and projects suggestions. We fully support at the African Union level the African Green Infrastructure Investment Bank initiative and its eminent advisory boards whose leadership, which will also count on its wise counsel on the institutional investor track of activities. As we prepare, as Africa prepares to host COP27 in 2022 under the Egyptian presidency. The African Green Infrastructure Investment Bank initiative will surely play a prominent role in the success and participation of a global institutional investment community and the private sector at COP27. I therefore look forward to supporting, and we from the African Union side look forward to supporting the African Green Infrastructure Initiative and its partners, facilitate this engagement and support the development and advocacy around the institutional investor-public partnerships model law as its catalytic legal and regulatory framework instrument in order to de-risk and crowd in capital for African green infrastructure investments. Thank you very much, and I wish you all, and I wish us all, very good deliberations. Thank you.
Thank you very much, Dr. Mayaki, for those important insights, and in particular for your personal leadership and the steadfast programmatic support of the African Union for deeper and catalytic partnerships with the domestic and global institutional investment community. I now have the pleasure to call on His Excellency Wamkele Mene, the Secretary General of the African Continental Free Trade Area Secretariat, keynote remarks. The floor is yours, Excellency Mene. Is yours, Excellency Mene.
Thank you for inviting me to share with you some of our thoughts on how green investment can contribute to advancement of the objectives of the AfCFTA. As you know, the African Continental Free Trade Area has now been ratified by 41 countries out of 55, signaling that this is the highest level of political support and, of course, the highest level of legal support amongst heads of states and governments across the African continent that the AfCFTA has been receiving. This has been the fastest instrument to be ratified in the history of the African Union. And that tells us the immense hope that this agreement is viewed by across a cross-section of our society, heads of states, civil society, parliaments, governments across the African continent. There's immense hope for the potential that this agreement presents to all of us. What is key, in my view, is how the investor community and the AfCFTA Secretariat can work together to identify opportunities for investment, for green investment, as it is called. And so I fully endorse and support the initiative by the African Green Infrastructure Investment Bank to make sure that we identify these opportunities for green investment in small, medium enterprises that may want to introduce renewable energy initiatives across the African continent, the establishment of green regional value chains, again, across the African continent, is absolutely critical that as we talk about industrial development in Africa, and as we talk about the productive capacity of African countries and African regions, different regions of the continent, that we have a clear strategy for how we are going to inject green investment into all our industrial action plans, into all our plans for rolling out the AfCFTA, so that the continent is not left behind, and so that the investments that we're making as a continent are investments of the future. Yes, there is the big debate that we all know that is happening in Glasgow as we speak. However, even without the imperatives, the global environmental imperatives that are taking place and that should take place, as Africans, we must, out of our own sense of responsibility, without those being compelled by those global discussions, we must, out of our own sense of responsibility as Africans, we must invest in green technologies, in renewable technology, in green small medium enterprises investments. All of these are very, very critical for positioning the African continent for the future. Now, we will start a new phase of negotiations, and that is negotiations on intellectual property rights, on investment, on digital trade, and a range of other trade-related infrastructure, a range of other trade-related supporting pillars. And I would like us to explore how green investments can support the AfCFTA and support this initiative of leveraging, because that's what the AfCFTA is. It is leveraging on a market of 1.3 billion people with a combined GDP of 3.4 trillion United States dollars. So I'm very excited about the prospect of collaborating with you to make sure that we have a green AfCFTA, and I look forward to meeting in person so that we can take this discussion to another level and see concrete results in terms of how we can make the
Thank you, Hubert, for inviting me to speak today. Fostering the financial conditions for a rapid deployment of clean energy in emerging and developing economies, including Africa, is one of the defining challenges of our times. To coincide with this event, the IEA published a briefing note on financing clean energy transitions in Africa in partnership with the African Green Infrastructure Investment Bank. Drawing on our previous research on Africa, we found that while per capita emissions in Africa are relatively low, the continent will be a significant source of future growth in global emissions without major efforts to transform its energy systems. So staying on track with 1.5 degrees Celsius involves shifting to a new energy economy with vast amounts of investment in clean energy. As set out in the World Energy Outlook released earlier this month, to meet net zero emissions goals, a surge in global annual investment in clean energy is required to around $4 trillion by 2030. Sub-Saharan Africa sees the fastest rising call on economic resources devoted to energy investment. And to keep the door open for the world to meet the goal of net zero emissions by 2050, even greater progress will be needed to boost investment. Africa has traditionally relied heavily on public sources of finance, but there needs to be a dramatic scale-up of private capital to fund nearly 60% of clean investments by 2030, with the private share continuing to rise over time. There is no shortage of private capital worldwide, but it is not finding its way to the countries, sectors, and projects where it is most needed. Sustainable debt issuances has soared to record levels, but we don't currently see the same rate of change in capital expenditures in clean energy projects on the ground. So it is critical to bring down the cost of capital, which is 7 times higher in Africa than in advanced economies, and sometimes even more. One of the defining features of energy transitions is the shift towards more capital-intensive technologies, which require higher upfront spending, but then have lower operating costs. Assets like wind turbines, solar panels, or electric cars. Many countries in Africa do not yet have a clear vision or the supportive policy and regulatory environment that can drive rapid energy transitions. Project-specific factors are often compounded by broader cross-cutting issues, which undermine risk-adjusted returns for investors and the availability of bankable projects. The international community must up its game to ensure all countries have access to the financing they need to bring modern energy technologies and new economic opportunities to their citizens. Mobilizing the huge wealth in global capital markets is critical to funding clean energy transitions, and this requires developing new mechanisms to link sustainable finance with opportunities to support SDG 7 and reward ambitious energy transition strategies. This includes actions to make it easier to prepare clean energy projects, get energy price signals right, and put state-owned utilities on firmer financial footing. It also means putting in place policies that support investable projects across clean power, efficiency, and electrification, as well as transitions for fuels and emissions-intensive sectors. The creation of new regulatory frameworks, such as the African Green Infrastructure Investment Bank's innovative institutional investor-public partnership framework, will help tackle many of these cross-cutting issues, allowing for the mobilization and deployment of private capital at scale and speed. Through its world-class data, analysis, and policy advice, and drawing upon successful examples around the world, the IEA will continue to explore ways to support the mobilization of private capital for clean energy transitions in Africa, notably through its work on an upcoming Sub-Saharan Africa Outlook next year. The task ahead is urgent and essential. Strong international collaboration and deep engagement with government policymakers and the financial community are required to enable ambitious strategies for attracting and efficiently deploying international climate finance. We at the IEA are fully committed to supporting governments, financial institutions, and private sector to reach net zero goals in a fair and inclusive way. We look forward to further collaboration with the African Green Infrastructure Investment Bank, the African Union, CFA New York Asset Owners Council, G20 Global Infrastructure Hub, and all other partners on the road to COP27. Thank you.
Thank you very much, Ambassador, for those keynote remarks, and in particular for your personal leadership on deepening and expanding our partnership with you. And we certainly look forward to many great insights and collaborations in the run-up to COP27. We will now move to Mary Lam Frendo, who is the CEO of the Global Infrastructure Hub, our partner, for her keynote remarks. Over to you, Mary.
I'm Mary Lam Frendo. I'm the CEO of the Global Infrastructure Hub, and I'm delighted to be providing this keynote for today's Partnership Dialogues series. Thank you to the African Green Infrastructure Investment Bank for inviting the Global Infrastructure Hub to collaborate with you on this series, and for inviting me to present one of the keynotes. So before we dive into our topic, I'd like to take a moment to briefly introduce the Global Infrastructure Hub work. The GI Hub is a non-for-profit organization that advances the delivery of sustainable, resilient, and inclusive infrastructure. Formed by the G20 in 2014, the Jihab actually works collaboratively with the public and the private sector to produce data, insights, knowledge tools, and programs that equally inform policy and delivery, helping decision makers and practitioners create positive impacts through infrastructure. According to the Jihab's Infra Outlook report, that the world will need $94 trillion to fund its infrastructure needs out to 2030, a gap that governments are unlikely to fill on their own. And this is where enabling institutional investor or patient capital comes in. Institutional investment is very well adapted and adjusted to infrastructure asset time span in terms of development and time for return on investment. In addition, the risk-return profile for institutional investors and the asset profile for infrastructure is well aligned. Although the involvement of institutional investment is key to bridging the full infrastructure gap, it is far too low and has an increase in the way that it was expected and needed to over the last 10 years. 10 years ago, the institutional investors' allocation to infrastructure was at 6%, with the expectations and needs for this to grow to 12% within a decade. Instead, it sits today at just below 7%. So why is this the case? Well, there are still some impediments from regulatory but also procurement frameworks to allow them to come at scale. The need to enable institutional investors' partnerships is actually aligned with the G20 infrastructure roadmap as an asset class, especially with the fiscal constraint and the massive infrastructure stimulus that have been announced by governments in response to COVID-19. These large stimulus packages need to be leveraged by the private sector. The public sector can't do it alone. And institutional investors have an important role to play right now. It can be a bridge between government's funding and the broader private sector participation. Having those institutional investors investing alongside government's budget is a natural next step and will be instrumental to get the private sector involved. Currently, only a few institutional investors are equipped with the required and dedicated expertise to deploy this capital towards infrastructure. The African Green Infrastructure Investment Bank would play a key role to bring capability and capacity to enable that investment from institutional investors into a trusted mechanism. In particular, supporting emerging markets will need the additional risk mitigation to be put in place to compensate their often low sovereign credit rating. Jihab is currently supporting this also on the government side by being a partner of the Africa Infrastructure Fellowship Program. This capacity building programs aims to upskill African governments' infrastructure specialists, enabling them to facilitate increased investment in a pipeline of infrastructure projects that will have a positive social and economic impact in Africa. This type of capability and capacity building need to happen on both sides, public and private, at the same time. Infrastructure is a complex system where both needs should be addressed at the same time in terms of capability and capacity building. So returning to my earlier point around the large stimulus packages that have been announced by governments, we're currently working with the G20 Indonesian presidency on designing a work program that is focusing on deploying this large infrastructure stimulus that will need to leverage the private sector, or it will be a massive missed opportunity. As mentioned before, we need the public and the private sectors to deploy this capital together to address the massive infrastructure financing gap. Institutional investors will need to play a key role in being this bridge to make it happen. Another related activity that is being done for the G20 is the Jihab work on regulatory capital. This work aims to ensure that all actors within the deal structure are able to deploy their capital at scale. a lot is needed urgently to look forward into building back better. And we need to address these issues in parallel instead of debating for too long what should be done first. Infrastructure is in crisis, and as infrastructure-related investment should and will become an important element of medium to long-term stimulus measures to help drive the global economic recovery, it is important to act now. Vehicles such as the Africa Green Infrastructure Investment Bank could play a key role in accelerating more sustainable, resilient, and inclusive infrastructure to help the continent moving away into a solid recovery. Thank you again for your attention and the opportunity to address you today, and I look forward to listening to the speaker of this important event.
Thank you, Marie, for your partnership and your dynamism. I have no doubt with your infectious leadership, innovative, just transition, institutional investor public partnerships will feature prominently on the G20's infrastructure investment agenda under the current Indonesian presidency. So thank you for those remarks. Now moving to our good friend and private sector ally, who happens also to be G20, which is the business industrialist group that works with the G20 political leaders. John chairs the B20's Finance and Infrastructure Working Group, and he's also the Secretary General of the International Chamber of Commerce, the ICC in Paris. Now over to you, John, for your opening keynote remarks. Over to you.
Thanks, Hubert. It's great to be with you today. Let's start with the African Green Infrastructure Investment Bank. I think you highlight an important and I think often overlooked area for climate policy and climate finance in particular. Specifically, greening international supply chains. Now, we've seen a lot of focus in recent years within the United Nations climate process on mobilizing ambitious net zero commitments from brand name multinationals. There's a very strong logic for that. And the climate plans set out by many of the world's largest corporations are really very truly impressive. But what that focus misses is the vast proportion of global emissions, over 50% are in fact tied up in corporate supply chains. So in this context, there is growing recognition that existing commitments may be meaningless without a strategy to reduce the so-called Scope 3 emissions. We at ICC have developed several initiatives to help support an economy-wide approach to climate action, such as the ICC Chambers Climate Coalition, the ICC SME 360X, but we also need effective government policies to genuinely incentivise and enable MSMEs to invest in a net zero future. Mobilising finance for this transition will be key. And when it comes to MSMEs, there is a clear lacuna in the Lord Stern doctrine on the economics of supply chains. Yes, there are significant mid to long-term returns on offer to companies from investing in net zero future. We get that. But that transition often requires significant upfront investment that many MSMEs simply cannot and are not in a position to make. Bridging this gap will be vital if we are to achieve the goals of the Paris Agreement. Last week, I launched a new ICC report on enhancing the contribution of the USD 700 billion export finance market to meet global stability goals. One of the key findings of that study was the need to establish joined-up financing approaches between development finance institutions, export credit agencies, national financing institutions, and other relevant stakeholders. To deploy CapEx at scale in these areas where it's actually needed, we need to have the most support from business in transitioning to a greener future. And I very much hope that the African Green Infrastructure Investment Bank will be able to play a catalytic role in such an ecosystem to help green supply networks across the continent.
Thank you, John, for those words, and in particular for sharing and supporting our vision that greening supply chains and African trade in support of the African Continental Free Trade Area is a Pan-African real economy transition plan. And as it's been put before, a once-in-a-lifetime generational opportunity for institutional investors and governments in Africa to design and share the climate and economic dividends of a greener and inclusive African and global trading ecosystem. Guests, that brings us to the end of the keynote opening ceremony. We will now be moving to the briefing segment, commencing with the first of two briefing announcements. The first briefing being the launch of the Model Law on Institutional Investor Public Partnership Initiatives and its preamble by Dr. Sharon Fitzgerald, who is the lead partner at the global law firm DLA Piper. By the way, DLA Piper is the official global legal services provider and partner for COP26. So we're in excellent hands. So the floor is yours, Sharon.
Thank you very much, Hubert. So just by way of background, as Hubert mentioned, I'm a partner at DLA Piper. I've been involved over a number of years in different forms of PPP projects. I've drafted legislation for PPPs and procurements. I've seen things that have worked well and things that haven't worked so well. But I think a key experience that I would share in terms of things that have worked well, and that has been when there has been true stakeholder engagement. And I very much look forward to being involved in the development of this model law and to be engaging further in that process of stakeholder engagement with you. So in terms of the model law, and our preamble, we have 5 key objectives. These won't be the only things covered in the law, but these are the 5 key objectives, which I'll just mention briefly before going into some details. But we want this law to incentivize collaboration between institutional investors and the public sector. As Dr. Mayaki said earlier, what we need to have is innovation. And so innovation comes through collaboration. And what we need to ensure in the model law is that we regulate appropriately. As you will all be aware, if we have a system that is too stringent, then that could stifle the innovation and collaborative. But we do need to have some sort of system. We need to have something that is robust for the public sector to be comfortable in terms of the partners, private sector partners that they'll be working with, but also confidence from the institutional investor community that the investments that they'll be putting into programs will be investments which will be well spent. And another objective in the law is therefore the fact that any investment needs to be made in accordance with international best practice. But we will also, of course, be thinking of not just what would work, for example, in my jurisdiction, the UK, but just to be thinking what will work in Africa. And we will, of course, be thinking that there are many countries in Africa, each with different legislative regimes. So something that works in one country in Africa may not work elsewhere. So we need to be featuring best practice, but also flexible. Key thing that we've heard in the keynote speeches is the requirement for there to be investment at speed. And very often we've all seen wonderful projects which don't go ahead ultimately because there has been some sort of hold up in the procurement process. So what we're looking to do in the model law is to build on experience and to fast track as far as possible the procurement processes which will be needed for the green projects that we were talking about. We also need another objective of the model law, which is to deliver both value for money for governments, but also recognised and bankable risk allocations. So often projects can go out with an unrealistic risk allocation in the contracts. That can lead to either there being no competition because there is no private sector interest, or it could end up in there being a very long competition where both private and private partners thrash out through negotiation the contract terms. We'd like to, in this model law, try and cut through some of that and derive some principles where we can start with a risk allocation that is fair to all parties involved in the transaction. And then in terms of the final objective, it's not enough to be procuring and signing a contract. That contract needs to be efficiently managed. Again, from experience, projects can fail because there is a lack of management of the contract and the project itself. So in terms of what I've been mentioning, you might say, well, these are features in PPP laws around the world. So what's innovative about what we're talking about here? And what's innovative is that we're looking to target a particular type of project. And those are the green infrastructure investment programs and projects that have been mentioned in the keynote speeches. In terms of how we define those programs and projects, that will be a consequence of our stakeholder engagement. As we all know, PPP can take many different forms, contract models, sectors. So the important thing here will be to recognise through the law the programs and projects that will make a real difference in terms of climate change. The law will incentivise collaboration through different mechanisms in the law. One of those mechanisms is through embedding within the law the ability for public and private sector to engage upfront in terms of developing and prioritising projects. So priorities could be on the basis of strategic importance to the delivery of NDCs, SBTs and net zero. It could be the level of economic and social benefit that the projects might have. It might be the balancing of successful delivery of those projects and ensuring that there is appropriate risk transfer. So there will be the ability to have that upfront collaboration, which very often doesn't happen. What you will see is instead governments going out with a programme, various projects, but not having engaged with private sector and the institutional investor community. We're looking in the model law at the role of sovereign wealth funds and public pension funds and how we can develop their role in the public procurement of these partnership projects. So we're very keen to be engaging and just hearing the views from these bodies. As mentioned, we're looking at fast-tracking, streamlining the procurement process. And so in the model law, what we're proposing to institute is a series of panels which are set up on the basis of selection criteria, aligning with the partnership projects themselves and the skill sets which investors and developers should have in terms of these green projects. So by using panels, we will enable the public sector to be then engaging with those who are on the panels and to be having either solicited competitions, so mini competitions, direct awards of the panel, or ability to receive unsolicited proposals from those on the panel. And the panels will be, could be sector specific, country specific. They can be designed in whatever way works best, and this will be another part of our stakeholder engagement. But these will be open panels, so it will be possible for new parties to join the panels at any time. Equally, if a party doesn't fulfill the criteria that are required for the panel, then they would be removed from the panel. There will be criteria will include probity criteria such as sanctions, dealing with sanctions concerns, fraud and corruption, money laundering, terrorist financing. So it ensure that not only are those in the panel qualified in terms of what the types of project that are coming up, but that they have the correct corporate credentials in terms of being on the panel. And as I mentioned in the previous slide, what we are looking to target in this model law is focus on bankable risk allocation from the outset. And that will be delivered through working in stakeholder engagement to design a contract model that recognises that there are differences in the risk allocation that are required in order to facilitate the investment that we're talking about. So in terms of doing all of that, it's all very well to come up with a new idea, but what we do, we must ensure that the model law is robust. So as mentioned, we need to be considering the risk of fraud and corruption. Also, we need to ensure that the model law deals with transparency and reporting. We do also need to consider governance, and that would be from both a public and private sector perspective. This isn't about fast-tracking private sector investment into projects only. It's in ensuring that both private sector and public sector are comfortable in the governance arrangements that are put in place in respect of the different projects that are coming through. We need to consider the interface with existing laws. So there will be in many countries existing PPP laws and procurement laws, and so it may be that the model law doesn't need to completely remove application of these legislations, that it may be that small adjustments are required. So again, this would all be dealt with in the context of the model law, but also the guidance note that will accompany it. Key factor is that in terms of what we do here in development of the model law is ensuring that we have knowledge transfer. It's all very well to develop a new law, but everyone needs to know how to use that new law and how to structure the contracts which will be signed pursuant to the new law. And finally, whatever we do, we must ensure that we are delivering or facilitating the delivery of quality projects. Speed is important, but we need to make sure that what is built, what is delivered, fulfills the function that it was designed for in terms of addressing climate change issues. So in terms of methodology and next steps, as mentioned, this is the first step in our journey of stakeholder engagement. We will be holding other events like this. We ideally have offices in Johannesburg, Casablanca, and Nairobi, for example, as well as a number of other offices in Africa. So it will be important to be engaging with both public and private parties, just to be talking about the particular challenges that need to be addressed in the model law. There will be some technical issues that we will need to look at. As mentioned, it's that balance of the laws that are already there versus this model law. How does that need to work? But just looking at the potential blockers to the model law. So for each jurisdiction, those blockers could be different. It could be to do with the time that it might take to implement a new law. It might be to do with other regulations that take primacy over this model law. So we will need to identify and then work through these issues. Part of the stakeholder engagement, we'll be looking at understanding lessons learned from other jurisdictions, and carrying out a comparative review of examples in the world where an institutional investor model has been successful. But above all else, as I said at the outset, what needs to be clear in the model law is that it's a tailored law, and it's something that would work from a practical perspective in the individual jurisdictions in Africa. And then throughout the drafting process, we would propose it's not just a case of speaking with stakeholders at the beginning, but it's in taking stakeholders along with us in the journey of developing the model law. And as we have a draft, then sharing and engaging with stakeholders in terms of what that draft might look like. And then finally, what we would really like to do is to identify and deliver some Pathfinder projects which are in line with the objectives of the law and can assist us with the development of the model law. As we know, sometimes it just takes running something in reality and practice to actually iron out any wrinkles in terms of what's been proposed, to learn from the good bits as well as the bad bits. So we'd be very interested in hearing from you on this call if there are any Pathfinder projects that you think we could actually use as examples where we can actually not just at COP27 report on a model law, but report on projects which have stress tested that model law. So that was everything from me. Thank you very much, Hubert.
Thank you. Thanks very much, Sharon, for the presentation, and congratulations on the progress that's been made and all the work that's gone into defining this preamble for the model law on institutional investor-public partnerships. We very much look forward to working closely with you and the DLA Piper colleagues and the CFA Asset Owners Brain Trust for the model law on the stakeholder consultation process that you've mentioned, not only across Africa, but also internationally, to essentially aid the expedition of that drafting process that you're sort of heavily into, and the ultimate presentation of the full model law, as well as the guidance notes that you referenced at COP27 in Sharm el Sheikh next year. So thank you very much for that. And I've already received a number of messages from people saying that this is really innovative. How can we be involved? And we'll facilitate that process. So thank you for that great presentation.
Thank you.
And we're now going to move on to our second and final briefing announcement, which is on the International Energy Agency's Africa research scenario. This is going to be a report by Tim Gould, who is the chief energy economist at the International Energy Agency, who many of you may recognize from his routine commentary on CNN and other global news networks. So over to you, Tim.
Thank you very much indeed, Hubert, and thanks in particular to you for bringing us all together at today's excellent discussion. I'm conscious of the quality of the panel that comes after, so I will keep these remarks brief, but I would like to just thank very much some of our distinguished opening speakers, Dr. Mayaki at the African Union Development Agency for his leadership on all manner of sustainable development issues across the continent, and His Excellency Wamkeli Mene, for the successful launch of the Africa Continental Free Trade Area earlier this year. But in these brief remarks, I wanted to highlight some aspects of IEA analysis and in ways that I hope will be useful for the panel that follows. First of all, the big picture on investment flows. Here you see our assessment of where investment has been in recent years in Africa and compared to what would be required within the next decade to meet Africa's rising demand for energy in a sustainable way. A few observations here. First and foremost, whichever way you think about the future, those investment flows need to rise and rise rapidly. At least a doubling and more like a tripling of total investment. But it's not just a question of volume, it's also the issue that we've come across in many of these opening statements. It's about the greening of those investment flows, the greening of infrastructure and supply chains. And so investment in clean energy needs to at least triple and increase more like 5 times. And when we talk about clean energy investment, we're not only talking about renewables, we're talking about infrastructure support, the integration of those renewables. We're talking about cleaner fuels. We're talking about end-use investments as well. And that would mark quite a significant change from the patterns of investment that we've seen in the past, where fuel supply has accounted for well over 2/3 of energy investment in Africa over the past 5 years. There's also an urgent need to regain momentum on energy access. We've had some positive developments, particularly since 2013, but that progress stalled globally in terms of access to electricity in 2020, and we anticipate that that stalling will continue through 2021. So there is really a very important role there for public finance to get involved and bring solutions to some remote areas, some areas where private investors don't see the necessary balance of risk and reward. And the final observation on this slide is that there is a tendency in many discussions about energy transitions to focus on clean electricity. And there's clearly enormous potential to increase the role of renewable sources of renewable power across Africa with all its renewable potential. But I think we also need to recognize that clean electricity is not the answer to all of Africa's energy needs, particularly for countries that are entering a very dynamic period of urbanization and industrialization. So we need to talk about electrons, but we also need to talk about molecules as well. And that brings me back to something that Hubert mentioned in his introductory remarks. There needs to be a conversation about the role of gases in particular, and that includes natural gas, where there have been important discoveries, of course, in recent years, as well as various low carbon gases and how they fit into the picture of Africa's energy transition. My next slide is on the sources of finance for energy investments in Africa. And this is what you're looking at on the screen is what we project would be required in a sustainable development scenario by the end of this decade. And the bottom line is that clearly public sources will remain very important, but as many speakers have emphasized, there needs to be a significant mobilization of private capital. So the amount of private sector finance increases dramatically in this sustainable development scenario to account for well over half of total energy finance by the end of this decade. There is that important catalytic role, though, of international and domestic public finance institutions, again, particularly for those areas where the private players don't yet see the right balance of risk and reward. And in some cases, that could be renewable power. In many cases, it could be energy access, but it's also kind of first of a kind projects, areas like industrial decarbonization and so on. And clearly there's a big role for international funding and assistance for capacity building, for financing consumer investments in efficiency, for example, and in helping to improve the financial performance of state-owned utilities, which, as we're all aware, has in many cases deteriorated substantially due to the pandemic. One other observation here, our analysis points to the increasing importance of debt financing mechanisms as energy transitions gain momentum. So in our projections, the level of debt financing increases from under 40% of energy investment today to more than half by the end of this decade, while equity is used primarily to fund early stage project development and riskier market segments. My next slide is looking at an issue which we've discussed to some degree already, and that's as we move to reliance on more capital intensive technologies through energy transitions, the cost of capital, of course, becomes a really crucial indicator. And we're all aware that our starting point today is that many African economies continue to face, pressing public health emergency, which has pushed up debt in many cases. There are heightened macroeconomic risks and domestic capital constraints. And if we put it all together, as you see on the screen, economy-wide nominal financing costs in Africa are up to 7 times higher than they are in the United States and Europe. And that points to a relatively high bar for investments in access debt finance and meeting equity return hurdle rates. So there needs to be much more collaboration between the international financial community and African governments to work on the energy policy reforms and financial measures that would help to narrow this gap. And in a recent report on financing clean energy transitions in emerging economies, we identified all sorts of elements that could help in this respect, along with numerous real-world case studies of approaches that have worked in different sectors and different countries. And you can see all of the case studies drawn from African experience in the background notes that we prepared for today's events. There's many more issues on the screen than I can cover in these brief remarks, but it's very important to have in mind the need to redouble international support. Very important to tackle some of those cross-cutting investment issues that have come up already in today's discussion, as well as some of the sector-specific questions that arise when you look at clean power, efficiency, but then also tougher sectors, industry, long-distance transportation, and the particular issues that arise for economies that are heavily dependent today on hydrocarbon revenues. And we've included some specific government actions in our background notes and in this report that may be particularly meaningful for institutional investors. And they include the development of policy laying out goals and emissions reduction targets accompanied by integrated energy strategies. The importance of regulatory reforms focusing on getting the pricing signals right and creating a market structure that allows for competition and transparent price formation. It means ensuring the processes for licensing, permitting and land acquisition are well designed and that investors are protected through strong contract enforcement and property rights, and that can help also to reduce the risk perception associated with some of these markets. And a final point from my side to emphasize that strategic Pan-African partnerships such as the Africa Green Infrastructure Investment Bank can provide a very important platform to overcome some of the key obstacles for both domestic and international investors. And that's through knowledge sharing, through the bundling of smaller projects, to provide a sort of central access point for international pools of capital. And additionally, such initiatives can enhance regulatory and contractual tools that allow institutional investors to partner with governments on bankable projects, as we've just heard in the previous presentation. One concluding thought, with the launch of the Africa Continental Free Trade Area beginning of this year, there's now very important impetus to create a coordinated pan-continental approach to green investment, and that could support access to the growing pools of sustainable capital from advanced economies. And that's the thoughts that I will leave you with. Thank you very much again, Hubert, for the invitation. I look forward very much to hearing the discussions.
Thank you very much, Tim, for those insights, and we certainly look forward to not only sort of thinking about those thoughts, but as we've always discussed together, taking real concrete action on some of these transformative opportunities, and really working with you to build out some scenarios where we can align them with this institutional investor public partnership framework that's been inspired and driven by African Union Development Agency and the Continental Business Network and a number of our other platforms that have been targeted on building this agenda in anticipation of, COP27 being hosted in Africa and our wider and broader infrastructure investment requirements. So thank you very much for those comments, and we look forward to our ongoing collaboration with the IEA. Well, this marks the end of our briefing segment. We will now commence our consultative panel dialogue on institutional investor-public partnerships, the African Continental Free Trade Area, and Scope 3 institutional investor financing solutions and strategies. Our accomplished and distinguished investment leaders for this panel include Mr. John Denton, who is the CEO and rather the Secretary General of the International Chamber of Commerce, Mr. Ziad Alexandre, who is the President of the World Association of PPP Units, Ayman Soliman, who is the CEO of the Egyptian Sovereign Wealth Fund, Nicholas Fursley, who is the Director General of the World Pensions Council, Ndabe Mkize, who is the Chief Investment Officer of Erscom Provident Pension Fund and the Chairman of the South African Asset Owners Forum, and Mr. Solomon Asamoah, who is the CEO of the Ghana Infrastructure Investment Fund. In this panel, each speaker will essentially just be sharing their views and insights on that link between institutional investor-public partnerships, the African Continental Free Trade Area, and that dynamic of the Scope 3 emissions that we are really going to be targeting, and we really want COP27 to be the COP that addresses innovations coming from the private sector and the institutional investment community, that addresses that elephant in the room, or elephant that's not in the Paris Agreement's text, as one might say, to get to that 70% of emissions reductions, which obviously is more significant, but not necessarily, more significant, I suppose, than Scope 1 and Scope 2, which are important, but which only sort of deliver that 30% quantum. So this conversation is really going to touch on these issues, and we're also going to hear from these colleagues the priorities that they would like to see from governments and the institutional investment community, sovereign wealth funds, pension funds, to support institutional investor-public partnerships in the run-up to COP27. So now I'm just going to quickly turn to John Denton, who we've already heard in his canned opening remarks. He's a true champion of the private sector, the small and medium-sized enterprises. I heard a very interesting comment when I was participating in the COP meetings last week. In fact, I was at a sort of quite a high-level event hosted by DLA Piper, and we were talking about decarbonization and net zero strategies. And then I think one very bright mind in the room turned around and said, I don't know why everyone's getting so concerned about Scope 3, because someone's Scope 1 and Scope 2 is our Scope 3. So I think the more we can look horizontally at how we can approach this, as a community, as the business community, I really do believe that between now and COP27 in Sharm el-Sheikh, we really do have a great opportunity to make it the COP that, really conclusively mobilizes capital in support of Scope 3 targets. But with that said, let me turn the floor to you, John, and we'll take it from there.
Thanks so much, Hubert, and a big shout out to all the participants today. I must say I was very interested in the model law discussion earlier on, as well as also the work of the IEAE. Now, I've just come out of COP27. In fact, I've just been working with my team on how we're going to respond to the draft statement that was issued. And actually, we look at it and describe it probably as limp. At the moment, we're actually determining that our focus will be in the next 2 days over Article 6 issues. So maybe I'll come back to that if we have an opportunity for Q&A. But one thing that really struck me at COP26, and that's what I really want to address turn my remarks towards today, was the power so far of the shift in attitude of the financial community. And as you know, in many respects, the financial community bending the financial markets to support action on to mitigate climate risk, etc., has been absolutely critical, and it's way ahead of government. And as a private sector leader, and ICC as one of the key drivers of that institutional response by the financial markets, we can say that that's actually contributing, I think, to a much greater, I think, improvement in the way in which governments are taking serious now, not just blah, blah, blah around action on climate change, but now at least feel that they need to cover themselves with fig leaves, which is actually a big improvement on where many of them were. And I'm an Australian, and that includes my nation state, my natural state of Australia. But one thing I did notice, and that's why I thought I'd take this opportunity today, is that in the midst of the financial markets, there's actually quite a quiet group, which I often wonder is hoping not to be noticed. But it's pretty clear to me that sovereign wealth funds are not doing the heavy lifting they need to do as a group. I know that there will be comments later on from Eamon, and I know that there's a lot of work being done in Egypt in this area. But if you actually look at the numbers, sovereign wealth funds, whilst they're recognizing that climate change is a risk and or an opportunity for their portfolios, their actions are not following their words. You know that sovereign wealth funds have only invested 7.2 billion in renewable energy since 2015. That's actually less than a third of the amount they invest in oil and gas, and represents less than 0.1% of the $10.5 trillion in assets held by sovereign wealth funds around the world. Now, we at the ICC have just repositioned the whole of the global trade finance market, which is $10 trillion, to align with climate change. You'd have to think that the sovereign wealth funds should be looking at this and wondering why they're not, and we should all be wondering why they're not doing more. So while there's growth in real asset climate solution, it appears to be about picking winning investments in isolation by sovereign wealth funds. Multi-asset or whole portfolio approaches are still in the minority. And I think we actually should be quite frank and sober in our assessment of this. To me, those figures show a chasm between the professed concern and deeds of sovereign wealth funds, between thoughts and action. And so by continuing to fuel climate change, sovereign wealth funds are actually failing the future generations who are supposedly the beneficiaries of their activities, and are certainly not living up to their long-term strategic and economic priorities. Frankly, I think we'll be hearing later on from pension funds, and I sit on the board of a number of pension funds myself, very active in investment. The fact how we would characterize pension funds generally as patient capital, sovereign wealth funds are the same. And you actually look at the difference between what pension funds are doing and what sovereign wealth funds are doing is actually quite significant. But for both, constitutionally, they are designed to take long-term views. Yet this sector more or less has kept its head in the sand, or hope not to be noticed, until after the Paris Agreement itself, and now appears to be taking only slow, quite too cautious steps in the right direction. To give you one example, the announcement by the One Planet sovereign wealth funds in July 2018 that they would only invest in companies that factor and integrate climate issues into their decision-making seems almost quaint, were it not so inadequate to the task at hand. What is urgently needed ahead of COP27, and this is what I'm urging, and we'll be running a campaign on this as well, because you won't be able to avoid scrutiny in this regard, and this frankly should have already been established, is a net zero initiative by sovereign wealth funds. This is not radical. This is not radical. This is not a departure from sovereign wealth fund mandates. This is conservative, shrewd, prudent, and effective risk management, and looking after the long-term interests of those who are beneficiaries of sovereign wealth funds. And we see it in other investment communities already. So we've worked to bring together the Net Zero Banking Alliance, currently bringing together more than 40% of global banking assets. We've worked together to bring together the Net Zero Asset Managers Initiative, and that's currently composed of 220 signatories representing 57 trillion. And we've also worked together to bring together the Net Zero Asset Owner Alliance, which is composed of 61 institutional investors representing 10 trillion in assets under management. So this is not radical. This is not a departure from mandate. This is conservative. This is shrewd. This is actually catching up. So what joins all of these initiatives above together is the support for the goal of net zero greenhouse gas emissions. You can talk scope 1, scope 2, scope 3, but what you actually have to do is do something about it, and you actually have to bring those greenhouse gas emissions by 2050 or sooner in line with global efforts to limit warming. And where is the comparable initiative to sovereign wealth funds? That's the question we asked today. We hope to have that resolved by COP27. And what we need is a net zero sovereign wealth fund alliance, and we will be working hard with governments And we'll be working hard with the public, with civil society and the private sector to ensure that this is an issue that's dealt with by the sovereign wealth funds who are supposed to be looking after our long-term interests. So thank you very much. I'm glad I had the opportunity to make these remarks here today.
Thank you very much, John. Clearly, you have some very specific feelings and thoughts about, how to translate that particular capital. And I know that colleagues on the panel from the community will definitely share, how they see it and what's possible. I think we're all starting at almost ground zero, if you like, just in terms of what really needs to be done in the private sector. So I think that there's a good opportunity for us to continue to come together and build on that. But no matter which sector you come from and what sort of capital you represent, it's going to be very complicated to deploy that capital on any level if you don't have bankable projects and investable assets and opportunities to pursue. So I'm now going to turn to Ziad, who represents the World Association of Public-Private, PPP units, just to really give us his views on the bankable pipeline and what governments and PPP units can do. And he'll also just sort of share some of his priorities that he'd like to see, as you have shared also, John, from governments and ministers of finance to support institutional investor-public partnerships that support the African continental free trade area. Over to you, Ziad.
Thank you very much, Hubert. I don't know if you can hear me, if you can see me.
I can see you very well, but you sound very faint. I'm not sure if that's...
I don't know. Can you see me? Can you hear me now? Can you hear me?
Yes, much clearer. Thank you.
I don't see myself on the screen, but I trust it.
We see you very clearly.
All right. Very good. Thank you very much. And congratulations to you on all the hard work that you're doing to make all this effort come to fruition through this meeting today and over the next year, all the plans that you have. Look, African economies are growing very rapidly. We all know that. So we know that investors are missing out on opportunities when they are not involved in that growth. But they are not. Institutional investors are largely not. And African governments are still relying mostly on donations to fund infrastructure, and sometimes even on China. And really, the remaining part is picked up by the multilateral development banks. So when African governments are thinking about, I have this project I need to finance, these are the people they think about. They're not thinking about institutional investors. They're not thinking about capital markets. So it's a two-way street. The institutional investors are not thinking about Africa, and African governments are not thinking about institutional investors because they think it's a lost cause. Nobody's going to be interested in what they have. Interestingly, a gentleman by the name of Henry Helmy has written a paper at the Sorbonne University that looked at how the investor field looks like and what the MDBs can do. And interestingly, the multilateral development banks, when they're involved in infrastructure projects, they do crowd in institutional funding, but only when that institutional funding is coming from investors in developed economies. When we look at investors from developing economies, such as some of the sovereign wealth funds or the local investors, etc., when they're looking at investors from developing countries, the multilateral development bank's involvement does not actually either has a no effect, or in the case of direct institutional investors, i.e. the pension funds, the sovereign wealth funds, and the insurance companies, it crowds them out. So everybody has to pay attention to what is going on. The multilateral development banks need to be very conscious of how their involvement may be crowding out some of the investors that are most needed to invest in infrastructure in Africa. International investors need to pay more attention to Africa and governments. And I get to governments. Now, What should governments do? Well, first, if you look around Africa, and we're here talking about public-private partnerships, because at the end of the day, this is what's important. We know that whatever government financing there is, they are going to deploy it, but it is never going to be enough. Nor is investment from multilateral development banks enough to accompany the huge investment in infrastructure, green or otherwise, that is needed in Africa. So we're looking at private investors. And through the international community, multilateral development banks, help, etc., every country in Africa today, almost every country has a PPP unit. And these units, working with line ministries, are supposed to deliver PPP projects. But they are not developing PPP projects. There are very few projects actually on offer. There's a lot of talk about pipelines. And here, maybe this is part of the answer to John Denton's remark. I don't know that it is fully the answer, but the problem is that many institutional investors cannot find projects to invest in. Why is that? Even though there's a lot of money going into capacity building in the PPP units, the answer is while we're training a lot of mid to low level government staff in PPP, the politicians are still largely unaware of what PPP is, how it works, what needs to be done to create PPP projects. And they typically want an airport and they want it built in 6 months. And this is not going to happen. And they get frustrated with the process and they say they fired the head of the PPP unit because they say it's not working. It's not true. It's just there's a lot of awareness that needs to be built among politicians. This is part of what we do at WAP. We have not been doing enough. Obviously, we need to do more. The second thing is that PPP units are not working in tandem with FDI promotion agencies. So the FDI promotion agency is on one planet and the PPP unit with this infrastructure projects is on another. Thirdly, they don't have enough funding to prepare the projects. So when a project is not well prepared, investors are not really interested in it. And by preparing good projects, today, there's a lot more than just doing a value for money analysis. They need to actually do a lot of the due diligence, legal or otherwise, that is needed. They do need to spend time on looking at environmental and social impact. Because if they get their projects rated, not only for credit, but for ESG, and there are many rating agencies today that rate ESG, if they get them rated, they will have access to a much wider international market, and that's not happening today. Another thing is working with investment banks. So when governments work with the multilateral development banks and their arms, they are many times missing out on a lot of the creativity that comes from investment banks. My experience through the 1980s and 90s working in Latin America, even when Latin America was facing many of the credit problems, we were able to come up with very interesting financial structures and innovative financing that is dearly missing today, not only in Africa, but in most of the developing countries. Somehow or the other, there's been a pause to creative financial structuring, and a reliance on just direct lending. So hopefully that when the involvement of investment banks with capital markets, granted that sometimes the risk needs to be tranched, the tranche that goes to such investors is different from the tranche that might be taken on by a multilateral development bank. One simple example, but of course this is not what I'm talking about, but it's like the loan A and loan B of the IFC. You can tranche the credit into various segments. I'd like to say that one area that is overlooked is agriculture. There is a huge potential for PPP in agriculture in Africa. Africa has a lot of very, very fertile land. Much of it is owned by governments or controlled by governments. It can be offered for PPP projects. This is green. It is what it needs is infrastructure. So we should think of infrastructure not only as infrastructure for communities, but we need to think of infrastructure and logistics for agriculture and solar energy. And using solar energy is excellent for irrigation and other matters. So I encourage African governments to look very, very seriously at infrastructure. One last word about WAP. We are a global association. We have 39 governments today as members, and we have other members that are corporate or institutional and individual. We have strategic partnerships with many of the global entities, UN entities, and other entities. And I urge everybody that's interested in PPP to consider joining WAP. It's a hub for interacting, exchanging information and experience. And we have actually been working on a model law with the UN and now with the World Bank. The World Bank is developing its own model law. So I think there's going to be very interesting developments when we share all these experiences together. So thank you very much for giving me this opportunity, Hubert, to talk to you today.
Thank you very much, Ziad, for those insights. I think you're sitting in a very pivotal position because everything seems to, vacillate around the importance of creating what has been described as this elusive bankable or this elusive investable pipeline. But, I think as you've identified, it's the market infrastructure that needs a much greater deal of innovation. And perhaps as I controversially say occasionally, I think we do certainly need some social distancing from some of the old practices and some of the old institutions who disintermediate, real willing capital that we represent, that is basically predicated on our commitment to growth. We want to see growth and prosperity. It's good for our capital, it's good for our portfolios, and it's good for the planet if done in a green and responsible way. So, we really look forward to continuing to engage you as part of the Brain Trust on the Model Law, so we can hopefully, get that relationship between our long-term institutional capital and governments directly, no intermediation from players that perhaps have a reputation for knowingly or unknowingly disintermediating long-term capital. So we very much look forward to that. So, you've talked about the World Bank. We've heard a lot about pension funds. I'm now going to bring them both together because I'm going to call on Nick Fursley, who is the Director General of the World Pensions Council, but he also sits on the Global Infrastructure Facility at the World Bank. Nick, you know the subject. The floor is yours to just give us your perspectives. Thank you.
Thank you, Hubert. And I'm going to thank you personally and the great Ibrahim Al-Hassan Mayaki for your exemplary leadership. My name is Nick Fursley of the World Pensions Council, and the WPC is a Paris-based think tank and asset owners research association, mostly pension funds, but also sovereign funds. First disclaimer, I'm a co-founder of the World Bank Global Infrastructure Facility Advisory Board. So I'm a member of the advisory board, so I give advice, but I have absolutely no executive role in that regard. Second disclaimer, what I'm going to say now is a reflection of my personal opinion. So it's by nature personal and I guess a little biased, or it's a reflection of my personal thinking. And I'd like to say that I really have fond memories of our discussions with Hubert in Little Cafe across the street from the IMF in Washington, D.C. in early 2016, on the heels of the Paris COP27 summit, during which I had the honor of chairing the Paris Summit Pension Roundtable with the Honorable Nick Cherry and Jeffrey Sachs. And 5 years ago to that day, the 5% African agenda was literally handwritten on a napkin in that DC cafe by Hubert Denso. And a year later, in 2017 at the offices of Covington and Burp, I think, near the White House. Hubert convened our old friends Gavin Wilson of the World Bank IFC and Pierre Guillain of the African Development Bank and myself for the World Pension Council for the announcement of really that momentous initiative led by Hubert at the crossroads, really positioned at the crossroads where, long-term investment, asset ownership, sustainable development, and legal innovation meet. And why am I saying that today? Because fast forward today, that 5% agenda has borne out some superb fruits, including prominently AfGIIB, the African Green Infrastructure Investment Bank, the advisory board of which we're also delighted to be proud of. And what I want to say is the following. I don't want to enter in a as we say in French, I don't want to enter in a statistical polemics, regarding what sovereign funds do or what sovereign funds don't do. And once again, I'm only expressing my personal opinion here, and I have a lot of respect for what the International Chamber of Commerce does. But at the same time, I think these statistics about the alleged underinvestment by sovereign wealth funds in green assets, or the fact that supposedly perhaps Western or Northern Hemisphere pension investors are greener or more progressive than sovereign wealth funds. I personally don't really agree with that statement, all the more because the statistics, the figures are difficult to assess, because unlike pension funds, a lot of what the sovereign funds do or don't do is under the radar, because a lot of the actual figures, the real percentages invested in particular geographies, particular asset classes by sovereign wealth funds is less publicly available than, let's say, for a Dutch or Scandinavian pension fund. So I think we may run the risk here of comparing apples and oranges, and we may run the risk of putting that Western white man's burden on the shoulder of these Arabian, Asian, African sovereign wealth funds. So let's not do that. And I think of course we can all do more. Pension funds can do more, sovereign funds can do that. And I really think that when you go to Abu Dhabi or Riyadh or Africa and you speak to many of these sovereign wealth funds board members, many of them have effectively put the sustainable development agenda at the core of their investment strategy. It's something that I really can vouch for personally. And I think you're seeing it in the Arabian Gulf. You're seeing it in Singapore, certainly. You're seeing it in China. You're seeing it across the African heartland. Sovereign wealth funds are investing massively in green assets. Once again, maybe not enough. And we can all improve our game, but what I want to say is that let's not pit sovereign funds against pension funds. I think all asset owners, all of them, be they insurance companies, be they sovereign funds, be they pension funds, be they from the Northern Hemisphere or from the global South, all of them have awakened. Maybe some of them have awakened earlier. So John Denton has a point. Maybe some of them have awakened earlier, but they have all awakened. And I think now that all of them have awakened, they are moving in the right direction. And even Australia, who had until recently a reputation of being quite regressive when it comes to green assets. Even US states like Texas or Alaska, or Alberta, which had a reputation of being not progressive or not ESG friendly. All these guys, Alaska, Texas, the Arabian Gulf, have belatedly moved very fast in that direction. So I think, let's be optimistic, as John Denton said, cautiously optimistic maybe, but let's be really optimistic about the future. And I think SWF's sovereign wealth funds are a force for good. And I just want to conclude, very briefly to say that here at the World Pensions Council, we are currently working with our friends at the EU ASEAN Center and the Singapore Economic Forum on the agenda of the G20 Pension Summit held in Singapore on the 28th and 29th of October, 2022, of course, with our friends from AfGIIB and Hubert Danso. And of course, the following week, early November 2022, we shall be present in Sharm el-Sheikh alongside our friends and colleagues from the African Union and AfGIIB. And I'm really personally very optimistic about COP27 because, you know, with His Excellency Abdel Fattah al-Sisi chairing, I think it shall be, I have no doubt, a superb COP27. Thank you, Hubert.
Thank you very much, Nick, for those words and that alternate perspective. That's really what we're all here to really share. You know, we're united by our belief that we can all do more. More needs to be done, and it needs to be done a lot quicker. And that's why, you know, we are working on creating that, as what Mark Carney would call it, the plumbing, the financial architecture rewiring that's going to be essential to get this done. So I'm now going to turn to, you know, North Africa, Egypt, Ayman, you know, our sovereign wealth fund leader on this particular panel. It's a shame that Duncan Bonfield, the president and CEO of the International Federation of Sovereign Wealth Funds, was on earlier, but he's been called away for, I understand, some more COP-related deliberations, which goes to the point to say that, you know, there's still a lot of engagement from the sovereign wealth fund community in that. But before I ask, you know, Ayman to sort of, you know, share his views, I would just firstly like to say congratulations to you. I know that you are working very hard behind the scenes as a sovereign wealth fund, working with government, sensitizing them to the economic opportunity for the region and the country of hosting COP27. So that's great news. And as I say, congratulations to you and the government. And we look forward to great things, and we will be standing shoulder to shoulder with you on preparations and everything necessary to make that an outstanding COP. So with that said, the floor is yours, Ayman.
Thank you, Hubert, and thank you, and hello to everyone. I'd like to say that we are fully aligned, and even listening to what Nick was saying and what Ziad was saying earlier, it's as if he is down here in Egypt, living with us, all the challenges that we face day in, day out. We all agree that the key challenges are the products, the investable products coming out of this part of the world. So Africa has so much to offer in terms of green infrastructure and green investments. And this is our new find. But the key challenge remains is bankable projects. And for us to keep up with the pace, to keep up with political expectations, and to keep up with KPIs that are being delivered, we have to lubricate and parallel track most of our efforts. So in that regard, I just, spur of the moment, listening to all the comments that were made earlier, I think the pipeline buildup and making sure that the projects are bankable for the sake of a PPP project or for the sake of a direct partnership, sovereign funds can play a significant role in bridging that gap. Because, as remember, Hubert, when we started our discussion earlier, when we said Team Africa, the sovereign funds of Africa are going to co-invest alongside development partners. So that is a different setup. That's something new. We're not an investment promotion agency. So IPAs, yes, are trying to crowd in investors, and DFIs are pouring funds of aid and funding those studies. But at the end of the day, no one does the hand-holding and co-invests alongside those partners and developers coming into Africa for the first time, or looking at Africa maybe a decade after they had been away from those markets. Things change very fast in Africa. We leapfrog in so many, either on the legislative side or on the economic development side, on growth, on demography, on infrastructure. So this is a land of opportunity. However, those that understand those opportunities best should actually put their money where their mouth is. And this is what sovereign funds are now going to do in Africa. And we stand firm behind this. So just as a land paving the way for the discussion, it is very important to note that, yes, we recognize the challenge in making sure that we cough out enough products and enough projects to be able to attract our fair share of the $100 billion annual investment budget towards green projects and towards infrastructure. And this is where we can have actually a positive impact. Not only do we aim to achieve carbon neutrality for our own economies or our own portfolios, we can actually aim to create enough surplus of carbon credits and enough negative carbon footprint for other developed economies that need to catch up and need to balance their portfolios. So we are less burdened by our legacy portfolio in our funds. We can actually become greener than most, and this is an advantage we need to put to good use. How do we get there? And these are the key challenges that I wish to address. So the first key challenge is, yes, there is a lag in legislation that allows us to trade those carbon credits. And to be able to trade carbon credits, you will need to be able to actually issue and certify your carbon credits. So these are some of the on-the-ground challenges. We are now launching a green hydrogen, 3 green hydrogen pilots in Egypt. We are involved in at least 2 of those. And the green hydrogen projects that are coming out of Egypt are built on solar and wind-powered electrolyzers that will need to produce green hydrogen, and you need to certify that the source energy is an additional source energy, renewable source energy, and to certify that the grid that is carrying that source energy is not contaminated by any other fossil fuel-based electricity or electrons. So there are actual challenges to make sure that this product is as green as we should certify it to be. So these are on-ground challenges. A lot of DFIs, a lot of Northern Europe and Western organizations are trying to lend help to try and bridge those gaps. But these are the on-ground challenges. So as investors, we are looking to replicate those. If we successfully manage to get one of those products to the market and fund it and make it a bankable product, then more should come. Egypt has had a famous story around the success of launching Ben Ben. Unfortunately, Ziad, this operated outside the realms of AfGIIB. It operated under a very special law for infrastructure delivery in partnership with private developers, but that was a cookie cutter, and it launched quite progressively. So I think there are many opportunities for us to address. And in that regard, what's the container that can bring all of those together? Where can we have that knowledge sharing, and where can we actually cross-fertilize our our capabilities and investment balance sheets? African Green Infrastructure Investment Bank is a good avenue for us to be able to pool our efforts towards that. It's not going to only be capital flowing between African investors, but it's also going to be within product development, within knowledge sharing, within best practices that can actually be replicated across, and where we can buy reel in good insurance providers, where we can reel in good legal framework. And I understand that through the COP, they're trying to create standardized contracts and standardized legal documents to make sure that these products are rolled out easier and faster. But I don't think this is the only challenge that we will be facing. We will need to have ministries of finance support with good guarantees to make sure that these projects are bankable, solid agreements. So some laws will need to be changed, and for us to be able to reach quantifiable goals. So these are the bulk of challenges I see way forward. But in return, it is definitely worth the pain, worth the effort, because the upside is massive for Africa in terms of offering green infrastructure, in terms of offering good plumbing, and I like that word, good plumbing between African economies as well, and that would help us become more sustainable as a continent. And this is an excellent opportunity to deploy capital towards those themed projects. Thank you, Hubert.
No, thank you very much, Ayman. And as I say, there's going to be a lot of activity. This is the road to COP27. You heard on the from Sharon in terms of the institutional investor public partnership model law that we're going to be looking for a lot of pathfinder projects with the support of the CFA Asset Owners Council. There's a brain trust of institutional investors already in place working on that. So we really want to come to COP27 under your good presidency with some very concrete initiatives, as well as the legal and the regulatory framework to do that. And I think the big thematic narrative that's emerging is, let's just not only think about decarbonizing our portfolios, but let's actually decarbonize our portfolios so our portfolios can green the real economy. And I think that strategic nexus with all the different types of capital that we have is really going to be quite a powerful confluence. So thank you very much for those wise and great words that you've shared with us there, Eamon. And you've served the Sovereign Wealth Fund community well by making what could, as Nick sort of talked about, could get lost in the numbers or confused by the numbers, something very real. The reality on the ground is always quite different from the unqualified text, that hasn't been qualified. So I'm now going to call on another African Sovereign Wealth Fund from Ghana, Mr. Solomon Asamoah, for his remarks, and then we're going to be completely and properly bookended by Africa's largest pension fund from the energy sector, Mr. Ndabi Nkize, from the Eskom Provident Pension Plan after Solomon Asamoah.
Thank you, Hubert, and once again, thank you for inviting me to participate in this very worthwhile panel. Thank you. As mentioned, I'm the CEO of the Ghana Infrastructure Investment Fund, which is a Ghanaian government-owned investment vehicle that has a very flexible and clear mandate to promote, develop, and invest in and manage infrastructure assets throughout Ghana. And we do that by trying to work closely with other sources of financing. We've been quite busy in the last 4 years, and we have managed to now have a portfolio of 12 infrastructure projects and have invested about $280 million US. But most importantly, we managed to attract $1 for every $1 of gift money. We've managed to attract $10 from other people's money into gift projects. So we have a very good track record of understanding how to structure our projects so that they remain viable and attractive to other sources of financiers, the private sector particularly, and international financiers particularly. So what we bring to this particular initiative is as we focus more and more on sustainable financing and making sure that our infrastructure is resilient and basically follows the principles of green financing. What we can do and what we offer ourselves as GIF, as a sovereign wealth fund effectively of Ghana, is the vehicle through which many of the on-the-ground projects can be structured and made available for international financing. So converting that if you like, that desire amongst financiers into practical individual projects that their money can find a home in. It's often said that lack of financing is less of an issue in Africa, but more getting bankable projects put in place. Well, we play that role in Ghana of making sure that our projects are bankable and of the structure that are acceptable for other sources of financing. And that's the role that we want to play. So leveraging other financiers is very important. Providing a line of identifiable, bankable, infrastructure-related projects with a sustainable component is also what we bring to the party. So whether we're looking at some of the projects that we've done, whether we're looking at a port expansion, whether we're looking at new roads, whether we're looking at renewable power projects, whether we're looking at any of these sectors, when we're looking at ecotourism or sustainable tourism, these are areas that we already have invested in, and we also have a pipeline of future projects, which will be able to attract that financing and be able to be sustainable and green. And that's what we really think we bring to the party. And we do that because we have a very close relationship with the government. As clearly we're owned by the government, they put us together. So we have access to government at the very highest levels, and that gives us an ability to unlock problems in our projects, which maybe perhaps other institutions may not be able to unlock. And as anybody knows, if you're doing infrastructure projects in Africa, you need to have a very strong relationship, or it helps to have a very strong relationship with government. So that's the role that we can play. We are owned by the government, so we have the weight of the state behind us, but we look at things through a commercial and a private sector lens, and we make sure that all of our projects are commercially viable, can generate cash flows, and can give returns to potential financiers. So we see ourselves really as an ideal potential partner for international investors and financiers looking for sustainable projects within Ghana. We also have a very unique approach in terms of working with other sovereign wealth funds. And this is one area that I think hasn't been exploited enough on the continent. Collaboration between sovereign wealth funds or between even pension funds, both domestically and internationally. Our role, we see, is to lay the ground so that those sources of financing find ready-made projects that they can work with. And similarly, I would urge other sovereign wealth funds in other countries to do the same thing, and eventually we'll be investing in each other's projects in each other's countries. And that will also facilitate intra-African collaboration, as well as facilitate the aims of the free trade area in terms of making investments happen across borders. So those are the areas that I think we can add value to this initiative. And as I said earlier, we are very happy to participate and work with anybody else who shares these aims. My view of the value of this institutional partnership law that we're putting in place is that it will provide consistency. It will provide international players with a framework with which they can look at, and also the countries and the governments can also look at the same framework. That will enable faster decisions to be made and therefore more investments to be done. Thank you, Hubert.
Yeah, thank you very much, Solomon. You know, this whole issue of collaboration and us as an institutional investment community is, you know, I think it's really reached the point now where it's how do we actually have an output from it rather than do we do it. So I think those are really apt and appropriate points. I'm now going to call on another manifestation of that degree of collaboration. I'm going to call on Ndabe Mkhize from South Africa, who, whilst he chairs South Africa's one of South Africa's largest pension funds as the CIO, he also chairs the same type of collaborative conglomeration of pension funds, a consortium of pension funds in South Africa. So the floor is yours, Ndabe.
Thank you very much, Hubert, and good to be part of this discussion. And I think a lot has been said. I'll try not to touch on what has already been mentioned, but I just want to say that representing the views of pension funds and other asset owners, we certainly see the importance of investing in green investments, ESG, as well as investing in infrastructure. We represent hard-earned savings of active members who then become pensioners. And they really want to have investments that generate a sufficient return for them to retire on, but at the same time create a sustainable world for them to retire into. Many of the events that we're seeing, be it COVID or be it some unrest we've seen in some other parts of Africa, necessitate the need for long-term investors to think about the other factors that are non-financial but are equally important. So we've seen some of the more innovative pension funds moving from the 2D investment world to 3D investment world, where they no longer just look at risk and return, but they look at risk, return, as well as impact. And without necessarily needing to sacrifice returns or dial up on risk, a pension fund or any other investor can actually drive impact. So we're seeing a lot of reform, especially in South Africa and Southern Africa, where pension funds are coming up with ESG policies to take into account the environmental, social, and governance issues, and are also increasing their allocations to infrastructure and real assets, playing catch up with what we've seen the rest of the world doing. And we believe that as we invest in infrastructure and ensuring that that infrastructure is green, and green meaning that it's not only is it good for the environment, but it's also good for social and governance factors. We see a greater shift towards investments that the African Green Infrastructure Investment Bank represent, and certainly what COP27 will be all about. And we believe that the investments of local pension funds is very key, because pension funds are commercial investors. We like DFIs. They play a very important role. We like government. They indeed do need to finance even some projects that are not so bankable. Not everything can be bankable. However, when pension funds get involved, they want to get involved in those projects that can drive, as we said, both returns as well as impact. So they resonate with the sovereign wealth fund. They resonate with international pension funds that would only invest if they are getting the returns as well as the impact. They are a form of a form of due diligence, or a layer of due diligence, because with them having local knowledge, if they're staying away in projects, they're not investing in those projects. Well, international players might as well ask, why are we investing if the local money, which is supposed to be smart money, is staying away? It also presents a form of skin in the game for the government of the host country. If they're going to go around asking for foreign capital to be deployed in their own country, well, if they would have a skin in the game if their local pension funds are invested, so that whatever legislation they make or change will affect not only just the international investors, but local investors. And I think that's basically what one has to also think about when you're looking at how robust the legislation is. If it can be changed at a stroke of a pen, you certainly want to know that local players are also invested. So we see the investments of pension funds in this space to really be important, because it will catalyze the investment of international money. So we in South Africa have formed an asset owners forum, South Africa, comprising of more than 10 of the largest pension funds in South Africa, which arguably represent, they number some of the largest pension funds in the whole continent. So it's a large pool of money, and certainly we aim to grow that even more. And one of the principles that we're going to be looking at, besides looking at infrastructure and real assets, is to ensure that we're taking ESG and green investments into account. So mobilizing those pension funds so that they can reduce the information asymmetry, they can reduce the cost of conducting due diligence, which tends to be the thing that preclude or militate against a larger allocation to infrastructure. That will go a long way towards promoting infrastructure, which will be green. So if we really want to be serious about COP27 and be serious about green investments, all we need to do is to encourage a lot of pension funds and other institutional investors to remove the barriers to investing in infrastructure. And in that way, we'll actually be putting our money where our mouth is. And when it comes to bankable projects, I think the REIPP, Renewable Energy Independent Power Producing Program, has been quite successful in South Africa. And now we've also seen a further step with the liberalization of energy production, such that one can generate up to 100 megawatts without necessarily needing a license. And that can actually be supplied to corporate and industrial off-takers. So that, in our view, would allow, as we've seen Amazon doing, being able to wheel energy that is produced somewhere in the Karoo, which is a semi-arid area, northern South Africa, while their plant or their offices are down in Cape Town. And that ability to wheel it through the national grid, Eskom's national grid, will allow a number of corporate and industrials to start taking this seriously, and therefore shifting and being responsible in their consumption, which falls neatly as well into scope 3 and scope 2 of emissions. So we believe that all those things are there. All we now need is to make sure that as the local pension funds and local and African sovereign wealth funds invest in these infrastructure, we can also catalyze and ask the international players to invest. We look forward to COP27. We certainly look forward to the involvement of African Green Infrastructure Investment Bank and the collaboration of the various Asset Owners Forum. And we will be launching officially the Asset Owners Forum South Africa on the 19th of November, so next week. We've been doing a lot of work. We're now going to be unveiling that, and which we've been doing together with the World Bank and USAID. Thank you very much.
Thank you very much, Ndabi, and many congratulations on next week's launch. I'm under no illusion, and neither, as I'm sure many of us on this platform are, about the work that it's taken to actually build that consensus and put the resources in place and set that program out. And of course, that's probably even more for you as the chair of that body. So many congratulations on that, and we continue to look forward to working with you on that particular plight. With Ndabi's fine words, that brings the panel to a close. Just as we close out the overall event in terms of next steps to support the process in terms of the road to COP27, we are today launching the African Green Infrastructure Investment Bank's advisory board it's essentially a committee from our advisory board that will support with the preparations and coordinate both domestic and global asset owners' participation and initiatives for COP27. So exciting times. We'll be calling on all of you to be part of that process, because you've brought us to this process, and we're grateful for that. As we close, please join me in thanking the speakers with our infamous virtual round of applause. Thanking each speaker for sharing their vision and their insights. And of course, for providing what we've heard from each of you, outstanding industry leadership. I'd also like us to, personally, and I think we can all recognize the partners that have made this platform possible: African Green Infrastructure Investment Bank, African Union Development Agency, the Continental Business Network, the International Energy Agency, the G20 Infrastructure Hub, the CFA, New York Asset Owners Council, and the African Sovereign Wealth and Pension Fund Leaders Forum. So as I mentioned, we look forward to reaching out to all of you in the new year on the consultative process on the model law, as Sharon mentioned, and to coordinate and prioritize asset owner initiatives that you'd like to see developed and showcased at COP27. Parting shot, I'd like to, all of us in many respects, to urge COP26 negotiators to dig deeper and unleash that genius of compromise, so we no longer delay and deny development to billions of vulnerable people and our fragile planet. I can only say, let's be on the right side of science, history, and deliver that just, inclusive, and equitable transition for all. And with those wise words, I thank you very much for accommodating our little time overrun, but I think the substantive conversations and the views that you've shared have been worth it. With that said, I hereby declare this meeting formally closed. Thank you very much, and be safe, everybody.
Doing business in Africa, you can't afford to be without Africa Investor.